Welcome back to Murthy Finance Academy. All right, today we're going to dive deep into a huge shakeup happening right now in the Indian cement sector. We're talking mergers, big money acquisitions, a total strategic shift. Here's what we'll cover. We'll look at what's really driving all this buzz, take a quick trip back to see how the industry used to be, and then really get into the nitty-gritty of the new economics and what the road ahead looks like, both the good and the bad. All right, first up, the big shakeup. So, what is really going on here? I mean, let's be honest, cement isn't usually the most glamorous sector, right? But suddenly, everyone's talking about it. Well, you're seeing it everywhere. Mergers, acquisitions, massive expansions. The industry is absolutely buzzing with these really aggressive moves from the big players. It's clear that something fundamental is changing. So that begs the question, right? Why all this sudden interest in a business that's famous for, razor-thin margins and super intense competition? Well, the answer is pretty simple, and it's huge. It's all about the massive, untapped potential for growth in India's infrastructure and housing sectors. And this chart right here tells the whole story. Look at this. India is the second largest cement producer on the planet, which is incredible. But our per-person consumption, it's way, way lower than the global average. You see that gap? That's not a problem. That's a gigantic runway for growth as the country keeps building. Okay, so to really get a grip on what's happening today, we got to rewind a little bit. We need to look back at the industry's recent history, which, to be honest, was a real mess. For years, the whole market was just super fragmented. You had tons of players, and this created a situation of chronic overcapacity. Basically, way too much cement being made than was needed. So plants were only running at about 65% capacity. What does that mean? It means companies had zero pricing power. This led to brutal regional price wars, and for investors, it was a nightmare. Thin, inconsistent profits. Just a tough business to be in. But here's the thing. That old world, it's fading fast. We are now entering a brand new era for cement. There is a clear structural shift happening that is completely transforming the entire industry. What we're seeing is a massive shift away from that chaotic, fragmented market, the one with all the price wars, to a much more consolidated one. It's now being dominated by just a few large, disciplined players who are absolutely laser-focused on efficiency. And this chart, wow, it really paints a clear picture. Just look at this. In the last 3 years alone, the market share of the top 4 companies has leaped from 48% all the way to 58%. This consolidation, which is being led by giants like the Adani and Birla groups, is finally bringing some much-needed pricing discipline and a serious focus on operational efficiency. But hold on, this isn't just about who owns what. It's a full-blown technological revolution. We're talking about really cool stuff like AI-driven logistics platforms, automation sweeping through plants, and these incredible waste heat recovery systems. And this isn't just talk. These innovations have already helped slash power and fuel costs by a solid 10 to 12%, and that translates directly to the bottom line, pushing a key profit metric, EBITDA per ton, back up to around 1,000 rupees. That's a huge deal. Okay, so now let's get into the nuts and bolts. How does this business actually work? Well, it all boils down to something called per-ton economics. See, building a cement plant costs a fortune. It's a huge upfront investment, which means most of the costs are fixed. So here's the magic. When demand is strong and those plants can run at higher and higher capacities, profitability just explodes. Every single additional ton you sell after a certain point becomes incredibly profitable. But you might be thinking, why not just run at 100% capacity all the time? Well, it's not that simple. First, you've got seasonality. Demand always takes a dive during the monsoon season. Second, there's just operational reality. These are massive, heavy-duty plants. They need regular maintenance to keep running. And third, and this is a big one, cement is a regional game. It's a low-value, super heavy product. So trying to transport it long distances gets crazy expensive really fast. So how do you get around those killer freight costs? The smart solution is something called split grinding units. It's a brilliant idea, actually. You make the core ingredient, which is called clinker, right there at the limestone quarry. Then you ship that clinker, which is cheaper to move, to smaller grinding units that are located way closer to your customers. Think of it like making the cake mix at one place and then baking the actual cake right near the party. This model is so effective that it's expected to make up 2/3 of all new capacity going forward. Okay, so this brings us to a really crucial point. With pricing power still being somewhat limited, the real battlefield, the place where the war in the cement industry is actually won or lost, is all about controlling costs. If you want to be profitable in this business, you absolutely have to master three key areas. Take a look. Power and fuel, that's the big one, making up about a third of the cost. Then you have freight, another huge chunk. And finally, the raw materials themselves. Let's dig into raw materials for a second. The name of the game here is limestone. It makes up about 85% of that raw material cost, so it's incredibly important. Securing long-term access to good limestone reserves has become a top strategic priority. It's so critical, in fact, that you're seeing big players acquire smaller companies just to get their hands on their mines. A perfect example is Adani's acquisition of Sanghi Cements, which locked in 1 billion tons of reserves for them. It's a pure strategic play. And this chart really highlights that push for efficiency on the energy side. The key metric to watch here is called the thermal substitution rate, or TSR. All that means is how good a company is at swapping out expensive fossil fuels like coal for cheaper alternatives like industrial waste. And as you can see, companies with a higher TSR, like Dalmia Bharat, get a major cost advantage over their competitors. It's a game of inches, and this is a big one. All right, so let's shift gears and look to the future. What does the road ahead look like for the Indian cement industry? Well, let's start with the good news. The demand story looks really strong. Now, while everyone agrees that demand is going to grow robustly, largely thanks to the government's big push on infrastructure, this chart here flags a potential storm cloud on the horizon. Look closely at that gap between the projected capacity and the projected demand out in FY30. There is a very real risk of oversupply if all these massive capacity additions aren't managed with a whole lot of discipline. And oversupply isn't the only thing to worry about. The sector is constantly juggling other big challenges. You've got ongoing regulatory scrutiny from the Competition Commission of India, which is always watching for any signs of price fixing. Then there's the volatility in global fuel prices. Coal and petcoke can swing wildly. And of course, there's just the sheer execution risk of managing these gigantic expansion plans and integrating new acquisitions effectively. So all of this leaves us with a really fascinating question for the future. In this new era of a consolidated, modernized cement industry, who's going to win the war? Will it be the players with the biggest scale, the ones who are just massive, or will it be the leanest, most efficient operators? Ultimately, the long-term winners will be those who can masterfully manage the cycles of cost, capacity, and capital with unwavering discipline.
If you like the video, please like, share, and subscribe to Murthy Finance Academy.